we start every single seminar with a little market update, and this one's no different. We're going to go over our market update, how the Calgary market's performing, and where we think it's going to go. It being August 1st right now, the Calgary Real Estate Board came out with the stats for July, and as it turns out, July had the most sales ever for Calgary, ever. So the Calgary real estate market is doing just awesome on the volume side of things. What we're seeing also is prices are starting to rise again. If you see the media's talk about Vancouver or Toronto, their prices fell from their peak last year, probably about 20%. Calgary never fell. We had an inventory problem, so our prices stayed consistent, and now we're starting to see them rise again. You can see on the left side of the screen, the benchmark price, which is the price of an average house in an average neighborhood in Calgary. It has gone up 4.6% over July of last year. Sorry, 5.7%. I don't know what I was reading there, but it's gone up almost 6% over July of last year. And that's a huge increase considering how interest rates have risen and they're trying to slow down demand.
Yeah, and you might be sitting there thinking, well, where is this market going to go? We've always said it, that the benchmark should be around 650,000. With the way the population's coming in, Tim, we may even move those goalposts. Yeah. But that is what would you say, Tim, our base where we're trying to get to. Now, this might take 1 year, it may take 3 years. We don't know how long it's going to take, but we believe the benchmark should be around 650,000. And when you compare that to where people are moving from, Vancouver and Toronto, Tim, what is that benchmark?
Yeah, that benchmark in Vancouver and Toronto is well over $1 million. So we're actually seeing people sell their homes in Vancouver or Toronto and then move to Calgary and buy a home for cash. So they can sell their house for 1.2. They buy a house for 567, 700, the average here, and they put $600,000 in their pocket. So that's incentive enough for people to move here just to unload the real estate they have in those very, very high priced provinces.
Yeah, and Calgary, you know what? It scares us with the amount of positive articles that are coming out right now. One article was Calgary is the destination for people that work from home. They're all moving to, it's the city with the most people working from home that they're moving to. So that is awesome. And then you're reading about the condo market, how much that's gone up this year. And Tim, you were just saying it's the lower price range properties that are really taking off right now.
So even though the majority of the sales are in the lower price ranges, our average price is still going up. So what we're seeing is these condos that 2 years ago were selling in the 190s are now selling in the 260s. So that's starting to drive the whole market as we go up in the price ranges, driving that whole market up. And you can see on the right-hand side, the inventory right now, we're at just under 3,500 dwellings for sale right now. That's down almost 35% from last year.
Yeah.
And if we look at 2021 and 2020, those decreases are like 50% down. To have a traditional balanced market in Calgary, we need about 5,500 to 6,000 listings on the market at any given time, and we're down about 2,000.
Yeah, and there's a bit of a catch-22 there because people aren't selling their homes because it's very hard to go and find a home to move into. And investors, they're not, what we're seeing in the condo market, Tim, is prices coming back to 10-year-old levels.
Yeah.
So what's happening there in the condo market is people have been holding on, and prices have finally come back and they can get out, make some money on it finally, and say goodbye to the condo market if they choose to. So there's a bunch of different things going on that, you know what, Tim, we don't even know the inventory levels going into the rest of the year. I mean, we don't think it's going to hit, where we were hoping, Tim, that it was going to get over 4,000.
Yeah, we are seeing new listings start to rise a little bit, but you see that percentage, the new listings are at 3,247. It's a 2.2% increase. So it's not a huge increase over last year. And we don't think we're going to see like 10, 12, 15% increases month over month. We just don't see enough motivated sellers for that.
Yeah. So you know what? At the end of the day, you look at the days on market, interest rates haven't slowed anything down, Tim. Days on market, 23 days. That's unbelievable. Going into August, we can expect pretty much the same as July. We may even have a record August.
Yeah, so that's our real estate market update right now for this month. What we're going to do now is bring in Danielle DeMarco. She's our mortgage expert. She not only helps you get a mortgage for your next rental property, she helps you develop a real estate investment plan so you can buy more than one.
Yeah, while you let Danielle in, we've been working with Danielle since 2000 and when we started, 2006, 2005. Yeah. And Danielle doesn't get our clients just a mortgage. She gets them a mortgage plan. So if you do come to us, once again, our aim is to buy you $1 million worth of real estate with as very little cash as possible to buy that $1 million worth of real estate. Tim, and that could be made up of 4 properties or 3 properties or 2 properties. All we care about is that those properties cash flow and that they're turnkey and that they'll rent out 100% of the time. We're aiming for 100% occupancy. And you know what? Danielle works out a way for our clients to get them there.
Okay, take it away, Danielle.
Thank you, guys. So today we just kind of wanted to talk about something we've been fielding a lot of questions about lately. You know, Tim and Azad touched on house prices and where we're at and how clients who waited a year ago are paying now $100,000 more. So obviously the higher the house price combined with these higher interest rates makes it more difficult to qualify for mortgages. So as a result, we're seeing a lot of people ask, you know, what if I want to purchase with a friend or have a cosigner? How does that work? So we wanted to kind of go through a couple of examples, and then I think Tim and Azad are going to pop back on, and we can maybe do a Q&A to kind of go through a few other examples. But essentially, if you and a friend are purchasing a property, there's a few ways that that mortgage financing can be set up. But it will depend on the type of property you're purchasing and the intended use of the property. So is it a home that's one of you's moving into? Is it a rental property that neither of you are moving into? These kind of things are going to determine how we can set that financing up. So to start off with an example, if you're purchasing a home that you are going to be moving into and you have a friend co-signing for you, where we would use your friend's income to help you qualify. So this would be an example where maybe the house price is a bit more than you can qualify for on your own. So we add on a friend, bring in their income, their debts, and they happen to make a decent enough income that it helps elevate your application so that you can qualify for more. In this case, the title is actually registered jointly as per normal, as per the bank's requirements. They would be considered a cosigner, but they would be considered a 50% owner in the eyes of the bank. Both of you would be on title, both of you would be on the mortgage, and that mortgage would reflect on both of your credit reports. So it would affect your friend's qualifying ability in the future for additional properties. Now, how do you divide? Let's say you're coming in with the down payment, but they're co-signing. You can divide that as in first money in, first money out. Basically, equity split, all of that can be dealt with in the form of a joint venture agreement, which is something you're going to want to have on file regardless, because if somebody's co-signing for you, but you're coming in with all of the down payment, maybe they're just co-signing as a favor, then you would want ownership to potentially be different or equity split at the end of the day to potentially be different. An alternate example is if you're purchasing a rental property. So let's say you and a friend are getting together, you're going in 50-50 on a rental property. Well, in that case, if one of you is going to do the mortgage and one of you is going to do the down payment, or both of you do the mortgage, both of you do the mortgage and both of you do the down payment, you can see how there's all of these different options. So how we satisfy that is again through a joint venture agreement and putting on there, okay, well, if it's first money in, first money out, let's say you put in a $20,000 down payment and your friend puts in 10. Well, it wouldn't necessarily be fair that at the end of the day, you guys split everything 50-50 and down the middle because you put in more capital upfront to start the process and purchase the property. So again, that would come to a joint venture agreement with maybe your 20,000 in is the first 20,000 out, their 10,000 in is the next 10,000 out. And from there, you split it 50-50. So lots of different ways we can do it, but either way, if you're both going to be on the mortgage, whoever is on the mortgage has to be on the title, and whoever is on the title has to be on the mortgage, vice versa. So that's important to remember. Another option would be, let's say you're qualifying for the home, but your friend is going to give you the down payment. So your friend is not going on the mortgage, not going on title, but you don't have enough saved up, but you qualify. They could give you the down payment, but there's a couple of ways only that we can set this up, because technically you are not allowed to get a gift from a friend And technically you're not allowed to borrow money from friends. So if that money had to be paid back. So essentially there's a couple ways we can do that. Your friend has a bank account. Let's say it's got $20,000 sitting in it, and that's going to be your down payment. They can either add you to that bank account. So then you can print off bank statements showing both your names on there and showing a 90-day history. Or you could open a new joint account with both your names. Your friend moves that money into that joint account, and we let that money sit there for 90 days. So that way you both have ownership of the account. Your friend can monitor it and make sure you're not taking the money out without permission. And then that money would sit there for 90 days. Once it's sat there for 90 days, then you can use it because then it's considered to be your own money. So again, that's a way for you, if you're able to qualify, but you don't quite have enough down payment, to get a down payment from a friend and still meet the bank's requirements. So a couple important things are, reminder that anybody who's going on the mortgage, they also have to be on title. And anybody going on the title has to be on the mortgage. So that's really important. This will affect credit. So if you have a cosigner or a friend, whoever is on the mortgage, that will appear on their credit report going forward for qualifying. Anyone giving down payment but not going on the mortgage cannot be on the title, and it won't affect their credit. So if you're the one giving a down payment, but you want your rights protected to make sure you get that money back if they were to sell, that's where that joint venture agreement would come in. And again, in the case where a friend is giving the down payment, but not going on the mortgage, the down payment can't be gifted. So we would add your name to a bank account or open up a new joint bank account. So those are kind of the highlights of how we would set it up.
Awesome, Danielle. Yeah, and the reason why we wanted Danielle to go over this is because it's becoming more popular. There's people that are renting out there, especially having roommates, and it's so expensive to rent. I think just being student rental and renting a room is $1,000 per room. So these days you'll find that it's going to become more and more popular where friends are getting together and buying property. So Danielle, I know, and this is what everyone has to understand, is when you're doing it a straight up 50-50 deal where either whoever, it doesn't matter who's putting the deposit down, we always believe that it should be a 50-50 deal. So what we're saying, or what Danielle is saying, is if I'm putting up all of the deposit to help a young person move into their property, that deposit will come back to me. First money in is always first money out. So that deposit, when we go to refinance or we go to sell, that deposit will come back to me, but I would help them qualify and I'm on the title then. So you're protected by a JV agreement and you're protected by being on title as well. So it's kind of a double whammy.
Yeah, and one thing I want to mention here is that Danielle talked about a whole bunch of different scenarios of two people getting together to buy that house. What we really caution people to do is follow the mortgage broker's instructions. They want it set up in a specific way so that you don't raise any red flags with the lenders. They have to follow certain steps to stay within their rules. So we just want to caution everybody that if you are going into a joint venture situation like this, is follow Danielle's instructions to a T, because she knows how to deal with the lenders.
Yeah. No.
Yeah, and then once you get the mortgage, again, lawyer's side, Tim and Azad's assistants, you guys can come up with a joint venture agreement that would protect your rights separate from the mortgage. And again, yeah, like Tim said, it's really, really important because the lenders are really strict in how financing can be set up. So if you do have questions about it, we can absolutely chat about it. But joint venture agreements, as Tim and Azad know, they can be set up any way that you want. The rules are endless. The guidelines are endless. If you want first money out, if you want 50-50, if you want someone to manage the property, but the other person's going to qualify, who's going to collect the rent, who's doing the maintenance, all of that kind of stuff can go into a joint venture agreement and cover a lot of those specifics. But as far as the mortgage goes, we have to make sure that we're following the mortgage lender's rules to a T.
Yeah, and so that's awesome, Danielle, because we know that everybody knows somebody renting, and if you could help them actually get into home ownership and help them start getting ahead instead of just throwing the money away each month. I mean, rents for a 2-bedroom condo are upwards of, $1,850, $2,000 a month. That's a lot of money. That's $24,000 a year going out, where that could be getting applied to a mortgage and now paying down that mortgage. And as we went through our market report, Tim, the condo market's just going to continue to go up. So they'll be doing very well. Or if they get into a duplex or a small starter home, the only way is up, helping out somebody that's renting. And that's a benefit for you because you then can qualify if they're moving into it for 5% down. So that is key to any investor, saving onto your cash flow there or saving onto the cash in the bank and spreading it around onto multiple properties. So hopefully that helps everyone out there. Danielle, thank you so much for that mortgage tip there. That was awesome.
You're welcome.
And we'll see you in a couple of weeks. If anybody wants to get hold of Danielle, there is her details. She's helped our clients, as we said, since 2006. She is awesome. We trust her, Tim, 100% with our clients. And you know what? The results speak for themselves.
Yeah. So thanks again, Danielle.